Okay, well, Deven, just stay on. We'll come back to you. M&M Finance reported a good uptick in collection efficiency, strong disbursements yesterday. So the company is on our radar after the Q3 business update. Remember, it was a 16-quarter high in terms of disbursements, but this has failed to translate into business growth. In more highlights, the company's asset quality as well as collection efficiency has improved. Ramesh Iyer, Vice Chairman and Managing Director at M&M Financial Services, joins us now. Mr. Iyer, good morning and Happy New Year to you. How has the growth been in the rural markets, and what kind of loan growth are you looking to do over the next couple of quarters?
So, the rural sentiments are pretty positive, and we talked about it even in the previous quarters, and I said that they are doing pretty well. The footfall at the dealerships continue to be good. All the economic activity around there, whether it's tourism, whether we are seeing on the road projects, any of the activity you take which drives to growth of rural is doing well, including the farm cash flows are holding up pretty good. So I think overall, that's what is reflected in our disbursements. And year on year, we are maintaining a 18% growth on AUM, and we continue to believe that the trajectory is going to be the same.
Good morning, Ramesh. A very happy new year to you. Good numbers that you all reported to light up your investors. But cost of money, that's gone up. So how do you think, if you can tell us how much cost of money has gone up, how much you're able to pass on, and where the margins will be under pressure?
So, if we borrow anything fresh today, it is up by at least 150 basis points. The good news is that we have a good ALM match, and therefore we don't need to really correct all our liability. So as far as our book is concerned, we have an impact of about 50 basis points as far as the borrowing is concerned. The overall average cost of borrowing goes up. We've been able to pass on about 25-30 basis points. There is still a gap of 20 basis points, which we think we will absorb and not pass on immediately. We do believe that in the next 2 or 3 quarters, one should start seeing some correction to even the borrowing cost, and that should help the margin better. For us, we have a lot of priority sector assets. Once we securitize, that should get us better margin, and that should offset the 20 basis point gap that we are currently carrying.
So steady margins is what you're expecting, unchanged margins?
There would be some dip, definitely in a quarter or two. They would get corrected as we move along.
All right, but NIMs of around 7.5%, I think, is what we were guiding for earlier. You're sticking to that?
No, so I'm saying that will be dropped by about 20-odd basis points.
20-odd basis points, all right. The other query, Mr. Iyer, is there is a bit of a gap in the gross NPAs because of the, INDS as well as RBI. The question is, have you provided enough? There won't be any fresh provisions that will be required, right?
So we've stated that even in the previous quarter, even in this quarter, that there will be no additional provision required because of the IRAC norm. Because if you look at our coverage, we are carrying a 58% plus coverage. The net NPA for us is about 2.5, 2.6. And the RBI requirement under the IRAC is a 6% net NPA. And that leaves us with sufficient provision that we are already carrying, therefore not required to make any further provision.
Any worries at all about asset quality? Your stage 2 amount of, collection efficiency is the same as the quarter ago. So no worries there, but what is the gut feeling?
If you look at a year back, we had the worst scenario out. We stated that more than 85% of it would get corrected. In fact, we have corrected more than 100% of it in less than 3 quarters of that. So rural is a typical market, as all of us know, and the 3rd and 4th quarter are the best. And we are seeing cash flows holding up pretty good. So we don't see any worry on any front. On the stage 2, in fact, you see this continuously coming down. So if you look at our stage 3 and stage 2 together, over any period of the previous quarters, it's shown continuous decline. So the trends are pretty much holding up there.
Is there any risk to this 18% loan growth target, considering that inflation could perhaps hit consumer spending?
I think, most of these assets bought are for their commercial use. And therefore, if there is a demand for that vehicle, I don't think they get so much pressurized by the borrowing cost going up, etc., etc. They look at how can they pass on the rate to their consumers finally. And that seems to be happening. So we don't see any pressure on the disbursement at this stage. As I said, footfall at the dealerships are pretty aggressive.
The reason I ask is because you also cater to the two-wheeler sector and car loans as well. And 2 pockets, two-wheelers and small cars, have been facing a bit of pressure over the last 6 months. There's been no real recovery there. Your thoughts?
So two-wheelers, we are not a very active player, but yes, car we are. What we see is in the small car segment, people actually are willing to pay a little more and move towards a pre-owned, little bigger car. So if you look at our pre-owned vehicle growth in this quarter has been one of the best ever compared to the past few quarters. So I think that gets offset. And then when you get demand from pre-owned vehicle, the margins also start to improve because the lending rates are better.
Okay. Any guidance on the AUM, your total assets under management? What are the targets you have set internally in terms of growth?
See, I mean, in this quarter, we had about 14,000 crore plus disbursement. We do expect that the future quarters would show similar numbers with demand being so high. And therefore, to maintain asset growth of 18-20% should not be a big challenge compared to previous year.
Okay. Ramesh, any other nuance you can provide about the company operations in terms of any AI you all may be using? Is there anything that investors would be excited to understand in terms of the operational running?
So we are running a project called Transformation within MMFSL. And what we are really trying to do is use up the large database that we have and try and see what are all the cross-sell opportunities that we have for our consumers. And that's one that you will see us in the next couple of quarters showing a lot of traction out there. We are sufficiently and adequately investing in our technology and the digital space. And as you know, we've created a special vertical called the digital finance, which is for small ticket loan, including up to two-wheelers. So that's taking shape, and you will see numbers coming from there in the next couple of quarters out there. And then the third piece is, with the vast relationship that we have across the country, our consumers are present in about 600,000 villages. And we know for a fact that our existing customer themselves are a very large ambassadors for us to get us more business. And therefore, we are running a direct marketing program where through our existing customers, we are able to actually bring a lot of new customers. And about 15-20% of our growth or business volumes comes from our direct resourcing. I think these three will really put us in a new shape in terms of growth and new volumes are concerned.
Just one final question. You said 18% is your target in terms of AUM growth. In segmental performance, two pieces that have improved quite a bit. One is tractor loans and the other is MHCV loans. Can you tell us what kind of traction you see here, and particularly for these segments, what is the growth that you see?
So tractors, what we saw was in the previous round, it was farm purchases which was happening. Now we see the contractors buying tractors. So clearly the haulage application is going up. And we do believe that the retails on tractors will maintain that kind of attraction even going forward. So for us, commercial vehicle is concerned, we are not a very significant player. Therefore, the growth should be looked at from a little lower base that we had. But we do finance LCVs and HCVs for less than 5 truck owners, etc. And we are seeing some demand out there. But our bet really is we believe the pre-owned vehicle segment will show much more aggressive growth because the demand there is very high. The supply there even was low because of the new vehicle non-availability. Exchange programs were not happening. We now start seeing exchange programs pick up, and therefore the pre-owned vehicle will show phenomenal traction.
Oh, that's good to hear. Thank you very much. That was a lot of nuances that you have helped us understand, Ramesh. Thank you for joining us. Have a fabulous 2023.
Thank you, and same to all of you. Thank you.
Thank you. Thank you, Ramesh. All right, Deven is still with us. Deven, thanks for waiting by. You heard the conversation. Your take on M&M